Kia ora. In this session, I'm going to explain how to prepare a profit distribution statement for the partnership business. First, you have to know why is it prepared. Profit distribution statement is prepared to share the net profit of the business between the partners. Net profit is calculated by preparing income statement. Once we know how much is the net profit, it has to be shared between the partners. And before we share this profit, we have to adjust for the income that the business has earned from the partners and expenses that they have made to the partners. Once these adjustments are done, whatever profit is left, that's known as residual profit, that will be shared between the partners according to the profit sharing ratio. Let me explain each element. Like I said, net profit. We get net profit by calculating income statement. From income statement, whatever profit is left, that has to be shared between the partners. Partners are charged interest on drawings. Interest on drawings are charged to partners to discourage them from taking funds from the business. Once partners start taking cash from the business, then business will run short of funds to pay for its debts and liabilities. So to discourage them, businesses charge their partners interest on their drawings. Partners receive interest on their capital, the capital that they have contributed to the partnership business. On that, partners get interest. Current account is also part of owner's equity, owner's fund in the business. Whatever money partners have left in the partnership business, they haven't taken it out. On that, they get interest. Partners also receive salary, whether it be a working partner or a non-working partner. It depends on partnership agreement how they are given the salary. In profit distribution statement, we record whatever amount of salary is still not paid to the partners. That is the salary that is due. Bonus is also given to partners to encourage them to work harder for the business. After adding interest on drawings to net profit and subtracting whatever partners receive from the business, whatever profit is left, that will be shared between the partners according to the profit sharing ratio. All the residual profit has to be shared between the partners and there should be nothing left at the end. Now let's look at one example. Question: Noti and Poti are the two partners who have started Otis Hardware. And from here we have to prepare profit distribution statement of Otis Hardware. First, we have to look at net profit. Net profit, we'll be able to get it from the trial balance under equity section. This is our equity section. And income summary is the net profit. And income summary for Otis Hardware, that's the net profit, was 165,200. Now let's read the question a bit before we start. Partners, the partnership agreement states that partners will get what? Interest on capital. Partners will earn interest on capital at 5% on their closing balance. These are their closing balances. Interest on current account will be charged or credited. In this case, partners will receive, they will be allowed because it's a credit balance on their current account. partners will get interest on current account at 4%. Both partners are going to receive salary. They'll be charged interest on drawings at 10% per annum, that means per year, on the amount above the agreed amount of salary. So if they are taking more than 55, if Naughty is taking more than 55, he'll be charged 10% interest on whatever he has taken extra. Similarly, if Potty has taken more than 40,000, he'll be charged interest of 10% on the extra amount he has taken. In this question, it says Naughty will receive bonus at 10% for the sales over 350. In this question, the sales that the business has made was 460,000. The sales for the year was 460, and Naughty is to receive bonus of 10% for the sales over 350. Now let's do the question, then you'll get the better understanding of it. Interest on drawings. Interest on drawings is charged at 10% on the amount above the agreed amount of salary. Salary for Naughty is 55 and drawings for Naughty was 59. That means Naughty has taken 4,000 extra. So on that 4,000, he'll be charged 10% interest. Similarly, Potty, his salary was 40,000, but he has taken 45. So on the amount above the agreed amount of salary, they'll be charged 10%. So Potty has taken extra 5,000. On that 5,000, he'll have to pay 10% interest. So 10% of 4,000 is 400, and 10% of this 5,000, 45 minus 40,000, 5,000, 10% of that 5,000 is 500. So altogether, the partners have to pay the business interest on drawing of 900. Remember, this is what is paid by partners to the business. So for business, it's their income. So that income they are going to add to the net profit. Now let's look at interest on capital account. Interest on capital account, 5% per annum. So 5% of 162,500 Naughty will receive, and 5% of 105,000 will be received by Potty. The partners are going to give them that interest. So Naughty receives 5% of that 162,500, that's 8,125, and Potty receives 5% of that interest on capital of 105,000. So he receives 5,250. Remember, partnership business is going to give their partners interest on capital, and for partnership business, that's an expense. That's why we are subtracting it. So altogether, the business is giving partners 13,375 that will be subtracted from the profit. The business is also giving interest on current account. Partners have a current account balance. It's a credit balance. On that, they will get 4% interest. So 4% of that 14,900 will be received by Potty, and 4% of 11,500 will be received by Potty. So that's 596 and 460. So altogether, the business is giving the partners 1,056 for interest on current account. Both partners will also get salary. The salary for each partner is 55,000, and for Potty it's 40, so we'll record directly 55,000 and 40,000, so altogether that's 95,000. Then for bonus, it says here Noti receives a bonus of 10% for sales over 350. So in this question the sales was 460,000, so over 350 he gets a bonus of 10%. So to calculate it, 460,000 minus 350 will give us how much extra he has sold. The extra he has sold is 110,000. So on that 110,000 he will get a 10% bonus. So 10% of 110,000 is 11,000. So Noti will receive 11,000 bonus. Now let's calculate how much is the residual profit. For that we have to add net profit and interest on drawings together and then subtract all those expenses made to the partners to get a residual profit. So residual profit is 45,669 after we have added interest on drawings to net profit and subtracted interest on capital account, subtracted interest on current account, subtracted salary, bonus. Whatever we are subtracting, that's given by the business to the partners. So for business it's an expense, we minus it from the profit, and whatever partners have given to the business, that's business income. So we are adding that. Partners are giving interest on drawings to the business. So for business it's a income. That's why to net profit we have added the income, and whatever business has given to the partners, expenses, we minus it, and we are left with a profit, a residual profit of 45,669, which will be now shared between the partners according to the profit sharing ratio. And the profit sharing ratio is 2:1. That means 2/3 will be taken by Noti and 1/3 of that profit will be taken by Poti. So 2/3 of 45,669 will be taken by Noti and 1/3 of it will be taken by Poti. So Noti gets 30,446 and Poti gets 15,223 out of that profit, residual profit. And at the end the partnership business should be left with a zero profit, because whatever was the residual profit, it has to be shared between the partners, and it has been shared according to the profit sharing ratio, that was 2/3, 1/3, that's 2:1. So all profit has been shared, there will be nothing left in the end. Now I hope this will help you to answer the other questions from the workbook that I have posted on Schoology. If you have any questions, please do ask. All the best.